All three major averages finishing in the green today. The Nasdaq up 1%. Our next guest is warning of seasonal weakness ahead for the stock market. But could strong earnings reverse the usual August malaise? Well, let's bring in RBC Capital Markets head of U.S. equity strategy, Lori Calvasina, as well as Regions Wealth Management CIO, Alan McKnight. It's great to have you both here. Alan, you're sitting here on set with me. Welcome. Let's start this conversation. What do you think of markets here? What would you be buying? Would you be buying?
I think right now, as we look across the markets, we think mid-caps are particularly opportune because you see the rally in the Magnificent Seven. When you think about what's happened with tech, when you think about comm services, utilities, we really want to try to find some opportunities that haven't already received all the benefit of these really lofty valuations.
Okay. Lori, seasonality at play here, maybe some consolidation after a record run. What do you think?
Yeah, look, I mean, if you look at the last 5 years, Morgan, August has been kind of mixed. September and October have tended to be weak. And if you look at the magnitude of the rally we've had off the April 8th lows, it really exceeds what we typically have when we come off a kind of a growth scare low, an extreme drop like we saw back in April. So we think the market has really recovered a lot in terms of a sentiment move, really done what it's deserved to do from that perspective. And now what we've got, there are sort of hopes of rate cuts again that are boosting this market in recent days, but that's coming against the backdrop of real uncertainty about the ripple effects of tariffs through the economy, not just inflation, but in things like demand and labor. And so we think the stage is getting set for perhaps a rocky fall.
Okay. Fed rate cut, would that be good for the market, or does it depend on why the Fed is cutting?
It's all about the why.
Okay.
And I think if the Fed is cutting because they're actually concerned and there's more of this pervasive fear, that's problematic. But if it's more in line with, we just think we need to reset and re-gauge based on where we are from an economic cycle perspective, we think it actually works pretty well. And I think the real name of the game for us is going to be around the consumer, the U.S. consumer. How is labor feeling? We've seen some of the numbers today. When you look at McDonald's, they're still doing quite well. But it's almost a tale of two cities, because then you hear some of these luxury brands that are suffering a bit. And so I think that's going to be, as we get into the second half of the year, what's going to drive the markets.
The continued bifurcation of the consumer.
That's right.
Lori, what do you like here?
So, look, I would say we still like the financials. And I'll tell you one thing that I'm getting a little bit irritated with the financial companies is that they're all saying the consumer is fine because they're looking at the higher level stats. If you listen to consumer companies, they're saying there's more pressure underneath the surface and real signs of stress starting to emerge. But the financials do have a point in that consumer balance sheets are still in very good shape, especially for the higher end. And the financials, we have to think back a few weeks to when they reported, but really do seem to be managing well, checking in on their customers very closely, really keeping a keen eye on sort of the risk profile of their customer bases, both corporates and consumers, and the valuations I think are pretty reasonable there. So we would stick with them. That being said, Morgan, if we have a little bit of an economic scare in here in coming months, they're probably going to take it on the chin, but we'd be buying on that weakness.